Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm Senior Manager of Trading and Derivatives Education here at Schwab, and this is Covered Calls and Short Puts. And today we're going to be talking about using technical analysis or charts for the timing of when to sell short puts, and actually going to be looking at things from two very different perspectives. One will be a short put seller who's looking to potentially own shares but at a lower price, and a second short put seller who would prefer not to own the shares. Instead, they're just really in this for the income. So two very different reasons why a trader might take a trade at two very different times. Should be an interesting discussion. Before we can get to any of that, though, let me first of all say hello to everyone who's already chatting in. Great to see all the familiar names. Great to see some new names. But hello there, Eva and Charles, Simone, Sharon, Lawrence, Mark, Kay Boja. Who else is here? We have Becca. Hello there. Lawrence, Tony, everybody else, thanks for joining us week after week. Hello there, Ricebird. Great to see everybody. Thank you for those that come back week after week. We always appreciate your attendance and your contributions to these discussions. If you happen to be here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts. But if you'd like to join us here in the live stream, this is a Monday webcast series, and we kick things off promptly at 2 Eastern time. Now, I also want to let you know, if you're here in our live stream audience, that my very good friend Barb Armstrong is joining us here in the chats. She's going to be addressing any questions that I can't get to just during the flow of the presentation. Thanks for having my back there, Barb. Barb and I would also like to issue an invitation to everybody listening to follow your favorite Schwab presenters on social media. So you can find Barb and me on X. You can find Barb there at Barb Armstrong CS. You can find me on X at Cameron May CS. And you can also find and follow me on LinkedIn. Just go to linkedin.com/in/Cameron May CS. But let's get into this discussion of timing and how timing can be very different depending on the trader's perspective. But as we do this, of course, we need to pause to consider the risks associated with selling short puts. As with other trading and investing approaches, there are certainly risks involved, so bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right. So let's quickly outline an agenda for what we're going to be covering today. We're going to spend the first few minutes looking at our current portfolio, and we have 4 example positions in place. And I wanted to contrast those positions with what's going on with the markets overall. So once we've done a review of those positions, see if there's anything that we need to do with those, we'll turn a little bit closer attention to the markets, use that as a backdrop for planning and placing a new income trade, which is going to be a short put today. But I wanted to talk about the timing of that sort of a trade and why 2 different traders employing the same strategy might choose to do it at 2 very different times. So let's get into this discussion. So here are our 4 positions. And if you look here, not going terribly well. Since we opened these positions, at least as they're currently constructed, we're down about $7,100, $7,200 across those 4. We have about $90,000 typical or conceptually committed to these positions. So that sounds like, boy, that's pretty rough. And it is rough. It's not great. But we have also, on these 4 positions, well, 3 in particular of the 4, already realized gains from income previously of about $5,200. So overall, yep, net still down about $2,000. I think this is the first time this year where I have to report that our positions, including their income histories, are underwater. All right. But as we go to look at each of those individually, I do want to look at the backdrop of the markets. What we might notice is that the S&P has pulled back. Boy, it's threatening right now to go down below, down 9.2%, almost to bear market territory, which is where the other major market indices have already been. So there's the S&P 500. The NASDAQ has actually dropped 13% from highs that were achieved back in October. We have the Dow, which is down about 11% from the highs from a couple of months ago. And finally, we have the Russell. Here's the Russell 2000, down about 11.4% in roughly the same time frame. So across those four major market indices, down about 11.1% overall. But I wanted to use that for some interesting contrast with what our portfolio has done. We're actually down on existing positions about 2% of funds committed to those positions, right around there. A couple of $1,000 on about $90,000 tied up. So it's not great, is it? But sometimes not great is actually not too bad. But let's go back to those positions, see if there's anything that we might choose to do about it. So with Apple, here's what we have. We're in a covered call, bought the shares at 265. Those are at 247, kind of getting pummeled. But along the way, we've been selling calls, and that's kind of eased some of that pain. Most recently, we sold the 17th of April 275 call. We collected 268 for that. That's only worth 20 cents. So I think the decision that we need to make right now is, do we want to roll this and retain ownership of the Apple shares, or do we just want to close this up? So let's go look at our Apple chart. So here's what we've been doing. We bought the shares back here, but this actually started off as a short put position. We sold a couple of puts. Those expired. We made about $550 from those puts. We sold some more puts. Those were assigned, but we made another $550 from those puts in realized income, but we were assigned the shares at 265. Now, along the way, since then, we've sold some calls. Actually, we didn't sell, so pardon me. That was not a $550 profit on that second transaction. We only sold one put that time. So we were assigned 100 shares, $270 of realized gain on the premium to add to the 550-ish from the previous trade. In any case, sold some February calls, made a 220 profit. Sold some March calls, made a 229 profit. Now we've sold those April calls for 268 that are now only worth about 20 cents. And this stock has been coming down. Now, right here, we have a note to consider exiting if our support has broken at about 244. You can see that level right there. We've been keeping an eye on that now for quite a while. I think we're going to, yeah, and actually, pardon me, you're actually exactly correct, Zinc 560. I just caught this out of the corner of my eye. I didn't mean to say bear market, sorry, correction territory at 10%. Bear market would typically be 20%. You're absolutely right. In any case, I think you get the concept. The point is that income has been doing us some favors here. Now, it doesn't always, because if the markets take off and run, sometimes those caps that we've imposed on our covered call positions prevent full participation in the bull market periods. So whereas sometimes it can help to soften the blow if markets pull back or if they kind of chatter sideways, it can also be a bit of a hindrance if markets are extremely bullish. All right, so here's our position on Apple. We're actually just below break even at this point, still above support though. So I think what we're going to do here, we're going to close out this, probably sell either a lower strike, possibly still for April. Maybe we'll look out to May, but we're still above support. So let's hang on to this one, but roll it out. Let's go have a look at what's available. Actually, let me tie this to the chart. Where might be an intermediate level of resistance? Not anything terribly clear, maybe right around there, just above 260. There was a touch point here, a touch point here, right back there. Could be a possible resistance. Maybe we sell something in that range. Let's go to the trade tab. And if I look to April, what do we have for strike increments? There is a 262.5 that we might be able to sell for those 18-day contracts. Looks like that's trading between $1.22 and $1.25. That's a little bit less than half of 1%. We basically only have half a month at this point. What if we look out? I'm going to go on out to the 15th of May and look at what might be available there, a 265 strike or a 270 strike. What if we did this? I'm going to roll out to that 270 strike. It looks like it's trading for about $2.80-ish, somewhere around there. We might be able to net a credit of about $2.60. So here's what that would be imposing on this trade. Let me extend my right expansion settings there. We're only seeing 15 bars out to the right. We're going to need to see more than that. Might take 30. Let's let's enter 30 here. Not even that is enough. Let's go for 35. There we go. There's the May expiration. So here's what I'm considering doing. Let's go above today's strike, or pardon me, today's candle. And we're going to draw in a line representing that new strike that we're thinking of maybe selling, that 270 level, right about there. I got it within a penny. That's pretty good. So this is going to be our new strike. So we're lowering a little bit, extending it out. But if we close this one out, I think we can close that out for about 20 cents. So how about we do that? Let's go to the trade tab, or let's go to the monitor tab. Right click on our existing call. Let's create a rolling order and select that calendar. A calendar just means that we're buying and selling options on the same stock, but different expirations. Let's actually modify this though. This one is to buy back the 17th of April 275 call that we're already in. And then we're considering selling out there in May, the 270 call. There we go. It looks like we might be able to get about a 260, maybe 263. I'm gonna go right on down to the natural and say that we're willing to accept as little as a 260 credit to get out of the call that we're already in, close that thing up, and get into a new one. Let's click confirm and send. And we're going to sell this, closing out the April contract, selling out there to May. There is a commission to close out the one to open up the next. That's $1.30. That could reduce our net credit to as low as $258.70 if this order fills. Let's send that order off. And let's see. Oh yeah, sold that for $262. Okay, so we just closed up that strike up here. We just make one quick modification there. Pink tells me that we're done with that trade, and we closed it out on March 30th rather than waiting until April 17th. So I'll just change the date there. There we go. And so that concludes this trade, and we're in a new one. We actually change this one to pink as well, just to indicate those are done. All right, so let me just do one other thing. I'm going to show you one other thing that I do. Let me go to my filled orders. So it looks like we closed that out for 19 cents. We originally sold it for 268, so almost 250. We actually realized a gain of 249. So we closed for a 249 profit. There we go. All right, next trade. We have our Amazon position. With this one, it's another covered call. Bought the shares for 235. Yep, they've certainly taken some lumps. We most recently have sold a call, the 225, for $1.69. It still has 47 cents of value, 46 cents of value left. I don't think we're going to be rolling this one today. But if we go look at its history, this one actually started off as two puts. Sold two puts. We closed one of those out for a 303 profit. We closed the other one out for a 365 profit. And then we sold some more puts. Collected $5.60 per share. Those were assigned, so it left us with a realized gain on the puts of about $1,120. But we did purchase the shares for $235. And then since then, we sold a call, and that expired for a 209 profit. That was for the March expiration. We sold some April calls. These are the ones that we're waiting on right now. Our break even is actually at 222.28, but yeah, price has actually fallen below that level. So this is a below break even trade. Even if we were to get to expiration, we need this to rally up here just to break even including all of the history. We've closed out 100 of those shares. We had a plan to close out the remaining shares if we break this support level down here. We're getting close, but not there yet. So I'm going to let that one sit. Our Broadcom trade is the short put that we sold just last week. sold the $300 put. With this one, we'd prefer for the stock to be above $300 if we don't want the shares put to us. That reduces that assignment risk. But let's go have a look at what's going on with Broadcom. Like so many other stocks, what it's done is taken a bit of a dip. So our break-even's at 292.65. We're about 50 cents below that. We need to get a little bit of a rally to stay above water at expiration. We need to go a little bit further to reduce that risk of assignment, the $300 strike. But this one, I'm just going to let it continue to work. Mary Burns says it feels like damage control on Amazon. It's exactly what it is, Mary Burns. But if Amazon continues to collapse, all that does, it's nice that we've sold calls. It's nice that we've previously collected some put income, but that's just applying a Band-Aid to the wound. What we're hoping is the stock doesn't continue to fall. If it does, we're just going to pull the plug. Sometimes you just lose money. That's the way it goes. But finally, we have NVIDIA. NVIDIA, I think we're going to probably need to roll this as well if we decide to keep it. We own 100 shares. We've sold the 17th of April 195 call, collected 420. We could probably close that out for somewhere around 20 cents today. But let's go see the history of NVIDIA. So this one, we bought the shares back here. So yeah, it's not fun that the shares have come down since then, but the income that's been collected has actually lowered our break-even point to 159.59. That also includes a couple of pennies collected on dividends. But with this one, bought the stock, started selling calls, sold November calls for a profit, sold December calls for a profit, sold January calls for a profit, sold February call, I should be saying singular, for a profit, sold March call for a profit. We've sold an April call, which we could also very likely close for a profit right now. And let's maybe just push this on out to May. Now, all the way along through here, because the stock's been going sideways, we've consistently been selling the 195 strike. And really, there's only been one day in the last, I don't know, few months where we even got above 195. We're probably going to have to bring this down. What if we were to look at maybe the 185 strike? That's coming across these highs. I think as we're looking at rolling this, I wonder if we can get any kind of a solid premium at 185. I'm going to maybe roll this one out to May as well. What can we get right there? Let's see. Let's go to our trade tab. Look at the May 185 calls, and those are trading between 285 and 288. That's a little bit more than, it's about 1.5% for about a month and a half for those traders or investors who prefer to get, let's say, the potential of at least 1% of income per month. That would look like that would satisfy that requirement. I'm not saying that everybody should be trading that way, but I think that's what we're going to do for this position. Let's sell that 185. So we're going to roll our April 195 to a May 185. So let's right click here, create a rolling order. This is to buy back the April 195, and we're going to sell the May 185. There we go. It looks like we might be able to get about a 270-ish credit. Let's say that we're willing to accept, I'm even going to go a little bit below the natural. Let's say we're willing to accept a 265 credit. And I'm basically doing that in the interest of trying to get this order filled as quickly as possible while the camera is on, so we don't have to sit around and wait to see if it happens. Well, let's click confirm and send. Selling, it's describing this as a diagonal. That just means that we're buying one in 1 month and selling another in another month. But we're closing out the April, that's the 195, looking to sell the May 185 for a minimum credit of $265 minus $1.30 commission, so $263.70. Let's send that order off, and I suspect that we should get a pretty, let me go to the working orders here. Yeah, I thought we were going to fill pretty quickly. Close that. We actually rolled that for 271 net. Excellent. So that's it for our current positions. Overall, a little bit underwater. We'll see what we'd like to see from here. is a near-term recovery in stocks with bullish positions like selling puts and covered calls. There is that upward bias, and markets haven't been entirely cooperative with that recently. Now, I want to go have a look at the S&P a little bit more closely for just a moment. Before I do that, though, I note that there is a survey that's been added to the chat window for our live stream audience. So if you're here in the live audience, if you'd do me a favor, click the survey link and then fill that survey out when the webcast is over, and give me some honest feedback at that time. I'll just tell you, it's a really short survey, 2 questions, that's it. And then there's a comments box and a suggestion box if you want to leave a few additional notes. But what I'll do is I'll tell you, I promise, if you take the time to fill out that survey, I always take the time to read through the data that you've provided. I read through your comments, and it's never a wasted effort. That's what I want to say. It's not going to drop off in the abyss and nobody looks at it. I will definitely look at it. All right, so thank you for doing that for me. But let's go have a look at the S&P just a little bit more closely. We're not going to scrutinize it. But one thing that might tie into our discussion here is the way that the S&P has behaved just over the last 72 trading hours. And what you'll notice here is the S&P had been holding up for months and months and months above the 6,500 level. I apologize for the dollar sign. I didn't put that there. That's the standard for any chart. We know that these are just points, basically. But in any case, the S&P has kind of broken a support level as it's pushing toward correction territory again. Thank you for that call out. But for some covered call traders, they may not, when they see something happen like this on a major index, it might cause them to kind of pump the brakes on going out and buying new stocks. Now, what it might do for some income traders, though, is they may still be okay with selling puts if their effort is to buy stocks at lower prices. Let's say that in the near term, our investor or income trader here thinks that stocks have a little bit further to go. Maybe they think they might come down for a little bit longer. Well, what they might do then is just park their cash and wait for prices to come down, if they do, and then buy some stocks then. Or they may get into an income strategy with an agreement to buy shares of stock if those shares drop it further in value. That's known as a short put, as long as we're selling out of the money. Thank you, Mark. Dollar sign accepts my apology. Yeah. Let's see. Somebody just asked a question. What happens if we had a call strike price of 70 and a stock falls at 50 and is bought at 62 and 50 premiums at 60 is in the pennies? Ooh, sorry, I won't have time to address that. It would take me a little bit too far off this discussion. But I do hope that if you watch a couple of these webcasts, I think you'll quickly be able to perform that math yourself. But it would be a little bit too much. Just in the interest of time, I won't be able to address that. But in any case, let's put ourselves in the shoes of a put seller who's looking to potentially buy stocks at lower prices. Now, not every put seller has that objective, though. But I want to go over now to Walmart. Here's Walmart. Why did I pick on Walmart? Well, we've discussed in the past some priorities that some income options traders might have as they're selecting their stocks. Number one is price per share. Now, if we're going to get into an obligation where we might have to buy some shares, we better make sure that we can afford those shares. Number two is liquidity. Illiquid stocks tend to have illiquid options. They're harder to get into and out of, harder to trade profitably. So really high volume stocks is a common priority for options traders of all stripes. But finally, what's going on the chart? And I wanted to talk about the timing of when to sell puts based on the final objective of the trade. Now you might think, isn't the objective to get income? Well, sometimes that's the primary objective. At other times, it's a secondary motivation. So here are two income traders. One is looking to buy stocks at lower prices than they can pay today. So that is trader A. Trader B is actually primarily motivated by the income that's offered. And if they have to buy the stock, okay, they will, but they'd actually prefer to sidestep assignment or the requirement to buy the shares if they can, all right? So how would trader A versus trader B look at the chart very differently regarding the timing? And it comes down to for some traders. Now, not every trader uses charts. Not every one of them sees that through this perspective. But trader A, who's looking to buy the shares, may sell their put when the stock price has already run up and it's starting to maybe come back down. So you'll notice with Walmart, we've kind of bumped up against a resistance area if we're looking at a descending area of resistance, a descending price ceiling here. And what I might do, I might look at April. We may even look out here to May for these. But why would a trader do this at this point? Well, they might see that it looks like our stock has come up. It may be running into a price ceiling. And if it comes down and they get assigned at a lower level, let's say maybe 120, or how low did we get right there? Looks like we got down to 118 right there. If price comes down, then our trader who is looking to get income, well, they get an initial income, but if the price comes down, especially if it dips below 118, there is a higher, do we call it a risk at this point? A higher likelihood of assignment of those shares. So that could serve the purposes of this trader who's looking for income plus hopefully purchasing shares at a lower price. So bottom line this sort of a trader quite commonly may look to sell puts when a stock is at a price ceiling or at resistance. Now, from a very different perspective, let's look at trader B. Trader B would prefer not to have to buy the shares. They may want the stock to go up after they sell the put, putting more distance between their strike price and a likelihood of assignment than the day that they entered this position. So trader A, let me just do this. Trader A looking to buy shares may sell when the stock is at resistance. Trader B, who would prefer not to buy shares, may sell when price is at support. Okay. Tim says income only would sell a shorter time frame. That can also play a role, Tim. Yeah, the longer we're in a position, the more exposure we have to assignment. Now, one of the trade-offs there, though, is if we sell very short-term options, we may have to sell strike prices that are closer to being in the money already, so that can enhance that assignment risk. But yeah. Now, Reggie's saying maybe a bear spread on Walmart. One thing that we don't get into, Reggie, because explicitly this webcast series is called covered calls and short puts. So those are the two strategies that we do. If you want to learn about other strategies, I actually do talk about other strategies in other webcasts throughout the week, but this one just covered calls and short puts. But does that mean that a trader who's familiar with a bearish vertical spread might not consider that at this point? Oh, yeah, they certainly might. All right, let's see if any other questions came in. I don't think so. I think we've covered this fairly well. So, which one of our traders seems to have their scenario cropping up just today? It looks like we're up here at resistance. Let's maybe, for this example, let's sell that put right now. And how about we use the chart to gauge the strike price? What if we sell? I wonder if we could sell the 118. Maybe we have to go to 120. Let's go look at the trade tab and see what's available. We'll start with April. The 118 put is about 1%. I'm only using 1% as a gauge. Not everybody looks at it that way. But that 118 put looks like we might be able to get about $1.23, 24, 25 maybe, which is just about 1%. And that's for an 18-day contract. I think we're going to probably do that one. If we wanted a little bit more premium, we could go a little bit closer to the current price, maybe sell the 120 strike. I'm considering though, let me right click right here. Let me edit the properties of this line that I've just drawn. And let's make it begin and end at 118. And I'm going to just carry that out through April 17th. There we go. That just kind of shows you the strike price that we're considering selling. Now, had I gone out to May's going to offer more premium. But actually, we don't even have a 118 strike to select if we wanted it. We might have to go to that 120. Could go down to maybe 115. That'll give us more wiggle room on the price, but maybe the trader isn't looking for wiggle room. They're looking for potential assignment here. Mark says much more open interest in the 120 strike. That's good observation there, Mark. What Mark's hinting at there is liquidity. Now, this is Walmart. Walmart's one of the most liquid companies on the planet. And so we already have one of the threats that poor liquidity can introduce to a trade. It can make it more difficult to get into or out of the trade. It can widen the spread between the bid price and the ask price and introduce more what we call trade friction or slippage. Even with the one with less open interest or less, yeah, that's what you were pointing out there, Mark, less open interest, we're still only talking about pennies on the width between the bid price and the ask price because of the very commonly elevated liquidity of Walmart contracts. All right, but I'm just going to go ahead with I think the 118 strike. Let's click on the bid price, and we're going to sell that put. Now, for this webcast series, let's maybe keep this a little bit smaller. One contract is an obligation to buy 100 shares at $118, about a $12,000 obligation. I'm going to do 2 contracts here. There we go. Dan says he's not worried about Walmart. The liquidity will happen. But yeah, but it's still a good point that Mark is raising, right? On some stocks, Walmart, we have a little bit more of a luxury of having pretty strong liquidity across most strike prices, as long as they're not too far out of the money or too deep in the money. But with lots of stocks, that's definitely not the case. So I think it's a good habit to develop to keep an eye on that liquidity so that we don't accidentally run into issues either getting in or even worse, maybe or potentially getting out. Let's sell 2 of these contracts. So we're obligating ourselves to potentially have to buy shares at 118. That might be exactly what our trader is looking for. And in exchange for taking on that obligation, looks like we might be able to collect in the range of $1.20, $1.21 per share. That might be about $240-ish across 200 shares. How about we just say that? Let's say that we're willing to settle for $1.20 per share on the 200 shares. And let's click confirm and send. I'm going to sell the 2 Walmart, 17th of April, 118 puts for $1.20. If we get that filled, that'd be a $240 credit at least, minus commission of $1.30 for the 2 contracts, leaving us a minimum credit of $238.70. And let's send that off. And while that's working, yeah, look at that. We're only asking $1.20. Right now it's trading closer at the mid around 125. I think this is very likely to fill here pretty quickly. There it is. Got filled. But that's the timing of entry on a trade. When might our Walmart trader here decide, whoops, this was a bad idea, let me get out? If our stock starts to rally, it's entirely possible that these contracts never get assigned. We just hit April 17th expiration, and the contracts just expire worthless, and we just keep the 240. We didn't get the shares, but maybe we go sell contracts on some other stock or do it again on Walmart. But if we start coming down toward 180, that raises that assignment likelihood, especially if we get down below 118 by April 17th. Assignment likelihood is even stronger, and so our trader might be thinking, great, I'm going to get my shares. I already have my $2.40. Now it was $1.20 times 2. Anyway, but there may be a situation here where that income investor or trader might decide to get out even before assignment. And that is if Walmart, I don't want to draw an oval here. Look at that, I just duplicated it. Let's remove both of those. But let's say that Walmart starts to collapse. And whereas maybe our income investor or income trader just thought, I got to switch my, how did I get back to that? Oh yeah, that's what I did. Let's switch up our drawing tool. Switch this to our trend line. Maybe they were just thinking we were coming back to our trend line or just below it, maybe down to this horizontal area of support. If we start to collapse and the stock is really under threat, even though we don't own the shares, we now have the potential obligation, we have the obligation to potentially have to buy the shares that are now in free fall. Maybe in that circumstance, the trader decides, let's just buy out of this obligation. This is where that liquidity can come in, right, Mark? Buy those contracts back, just be done with it. Okay, but let's go, actually, I was gonna say, let's go place the trade. We already did the trade. So with that, I've actually accomplished what I wanted to talk about today. Today, I wanted to review how there can be two very different motivations regarding the timing of when to sell puts. And it really comes down to, does the trader want to minimize the likelihood of assignment? Are they mostly oriented by income? Or are they looking for share ownership in addition to income? Very different perspectives. So we look at how the timing can be very different to service those two perspectives. Let me see if I missed any other questions. Mike says, hey, I'd be likely to ask for $1.25, so I put mine in at 120, right, Mike? Just in the interest of trying to get this thing filled quickly. But what Mike is proposing is he might go for $1.25, try to get that extra nickel out of this trade. And if we do that over a range of trades over the entire year, for those that fill, that could really add up. Now, obviously, with each one of those, that also raises the likelihood that we just don't fill. So there are pros and cons, but thanks for the little suggestion there, Mike. Tommy says the best time selling a put is down, not up. Not sure what you mean. I kind of get where you're coming from there. Put down, not up. Tommy, a play on words. It really does. It can depend on the trader's motivation. Now, when I teach a concept like this, it's always for educational purposes, and I do not expect everyone in my audience to agree with it because not everybody approaches even the same strategy the same way. Okay, everybody, thanks for, yeah, Dan says it looks like it filled for $1.26. What did it fill for? It did fill for $1.26. So we put in a minimum acceptable of $1.20. We actually got more than that because there was more available at the time. But in any case, we've accomplished what we set out to do today. We wanted to take a quick look at our existing positions, frame those within current market conditions, and also use that as a foundation for the discussion of planning and placing a new trade. And today was all about timing, how those two traders might see the timing very differently. So hopefully this was an interesting discussion for you. Prakash says high implied volatility gives good premium. Implied volatility is pretty strong right now, which also we need to be aware. Also means there may just be more uncertainty, greater volatility ahead. We'll see how these trades play out. But everybody, this is what we do with our Monday discussions in covered calls and short puts. I hope that you'll put it in your calendar to join me on Mondays, or of course you can just watch the archives, which certainly raises the point. If you haven't done this already, make sure that you've subscribed to our Trader Talks channel on YouTube. So it's Trader Talks Schwab Coaching Webcasts. You can subscribe by clicking the subscribe button right below the video stream. It only takes a second to do that. It doesn't cost anything to do it. But this is where you can join our live streams. You can also find playlists of previous webcasts. And since this one is almost a previous webcast already, this is where you'd go to find it. You go to playlists, scroll down, and right here toward the center, toward the bottom, you'll see covered calls and short puts. Click on view full playlist. There's last week's discussion, week before, and pretty soon you'll see this webcast added to the top. Now, another thing that Barb and I would suggest you do is follow us on social media. You can find and follow Barb and me on X. You can find Barb there at Barb Armstrong CS. You can also, you can find me on X at Cameron May CS is my handle. So this is the guy you're looking for. There's my background photo there. But Barb and I are very active on X. And if you reply to one of our posts, let me just speak for me. If you reply to one of my posts, I always try to reply right back. I don't like to make obligations for Barb. She can talk herself into a corner if she wants. But if you reply to one of my posts on X, I just try to reply right back to you. Social media is the place to get in contact with your Schwab presenters in between the live streams. You can also find and follow me now on LinkedIn. Go to linkedin.com/in and then /Cameron May CS will take you to my profile. You can give me a follow there as well. But time for me to let you go. There's another reminder, Barb. Thanks for reposting the survey. So for those that are here in the live audience, if you now click on that survey link, if you haven't done that already, fill out that survey, two questions, and then a comments box and a suggestion box. I just promise you, I will read that survey information that you provide. I read your comments, I read your suggestions. It's always very helpful. Thank you for doing that. I also want to thank everybody for the thumbs up that have been provided out there. If you watch one of our webcasts and you liked it, then click that like button. That is a pat on the back to your presenter, but it also gives my videos a nice little boost in the YouTube algorithm, helps more people find these discussions like the timing of when to sell puts. So I'm going to let you go. Just to let you know, though, Liz Ann Live has been canceled today. So she'll be back in a future week, but not this week. I will look for you on social media, guys. I'll look for you on X and on LinkedIn. I'll also look for you in a future webcast. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.